Right. Good evening, everybody. It's now 6:30, so the meeting is open. I need to read this as a starter, which is the fire evacuation procedures. There are no fire alarms scheduled for this evening. Therefore, if the fire alarm sounds, please evacuate the building immediately. The fire exit is located at the side of this room. Exit through reception and meet in the War Memorial Park. The webcast of the meeting this evening is being webcast live on the internet and will be available to view on YouTube after the meeting. Yep. Just on mobile phones, if you could set them to silent, that would be good. Thank you. Right. So, on we go. Apologies for absence and substitutions. We've got one. We have apologies from Councillor Gavin James, who's had a reaction to his booster jab. So he can't claim to be one of the Basingstoke Omicrons, not just yet. So we wish him well. Are there any declarations of interest? No. Urgent matters? I don't believe we have any urgent matters. So it's on to the minutes of the meeting of the 27th of September. Are these an accurate reflection of that which was discussed? Yeah, okay. We'll take that as approved. So we're on to item 5, which is simply a summary of the investment income and property age debt, which is for our benefit, so we don't have to go through individual reports to see that. Do we have any comments or whatever on the summary of investment income? I think it's probably as expected, so there's no surprises or nasties in that. Councillor McCormick.
Thank you, Chair. Page 15. It's not a. It's a very, very short report. Just wanted a bit more expansion on Property Service Council. So we've got £1.2 million of aged debt on that, which is, as I understand it, outside the payment terms, which is typically a month. But 1.2 million is quite a lot of money. Is that from tenants of our properties, like community halls and that sort of thing? Do we have any possibility with a slight breakdown on that? Obviously, we can't go down chapter and verse into it. We probably haven't got the information in front of you tonight. And similarly with JLL, I presume that's Jones Langs LaSalle. Are they managing the malls on our behalf? And is that aged debt as a result of empty shop units, or shop units that are behind on their payments and are going to be empty if they struggle to meet their payments and get declared bankrupt?
Thank you for those questions. The property services, yes, we can have a look at how we can break that down a bit more, perhaps across categories. And you're absolutely right. It does relate to the properties where we are the landlord and we have tenants in there. Some of the debt that's classed as age will be because we've got them under arrangement. So where people have struggled and we've rearranged it, we still know that debt is obviously aged. So it's reported as such. But I can have a look at the more detail and see how we can expand that for future papers. JLL, yes, you're absolutely right. It is Jones Lang LaSalle who manage the malls for us, and the same is true there. Again, there are some payment arrangements in place, but we do go through that closely with them and make sure that, again, they're actively managing the debt, looking to put payment arrangements in place. And you're right, if we don't have some of those arrangements in place, the risk is that the tenant will disappear. So it's those balance of probabilities and normal debt collection processes.
Yep, carry on, Councillor McCormick.
Yeah, so are there any other shopping schemes in Basingstoke that JLL manage, like Brighton Hill Retail Park, for instance?
I don't know the answer to that question without asking colleagues in property, but I'm happy to find out. Certainly, what's reported here is the entirety of what JLL manage on behalf of Basingstoke Council.
Councillor Putty.
Thank you, Chairman. The property services, when we're talking about that, are they just commercial properties or are they a mix?
If you mean by a mix, they are commercial, industrial. It's across our portfolio that's reported in our property strategy. So it's any property that we own. It's a mix of retail, some commercial, some industrial. There's no domestic in there.
And with regards to that debt, recover the debt via insolvency process, and it says here, ultimately it means request for debt write-off. The thing is that we've been writing off lots of debts in the past years. I think we have done so. So how really, because writing off debt, and then the thing is that, is there no other way that we can recover some of it?
We do take every thing that's available to us to recover debt. When the pandemic took hold, there was actually a moratorium on being able to recover commercial rent. We weren't allowed to take active recovery. No landlord was, so it's not unique to the council. So we have literally been having to work by agreement with some of our tenants in different properties, which we have been actively doing. We do take everything that's at our disposal in terms of the routes that we can follow. And it's unfortunate if a company goes into insolvency, we clearly file our claim. We do get some very small dividends from time to time, but we try and prevent that by having engagement, or where we've got agents acting for us, that they have active engagement. We do write off where it's appropriate. Obviously, if something is insolvent, we write it out of our books in line with our debt management policy, and some of that is delegated to the Section 151 officer, but quite a lot of it has to go before the leader, and we do an annual report, and the last one was done obviously for last financial year. And I don't believe that our debt write-offs are disproportionate, and they're certainly well within any provisions we make for bad or doubtful debt.
Yeah, Chairman, I come back again. Can we have like the last 5 years of debt write-off?
As they were published, certainly as far back I can look to see what's available, but certainly I know for a fact last year it was a leader decision that was published, so I can look to get you the links for those.
Yeah. We at some meeting, I can't remember which one, we do get the age of debt report to discuss in more detail, because there are issues. I think to clarify one point, this debt, does it only appear after a certain time? I.e., debt is only considered to be debt if it's out with of its normal collection.
That's correct. I mean, clearly, once an invoice is raised, it's due to us, and then we monitor it. That's a debt that's outstanding for 30 days, 60 days, 90 days, and we do break it down over the time period. Yes, that's correct.
Any other? Councillor Poland.
Thank you, Chair. Suzanne's probably covered the point. When I saw the notes, my comment on it, following on really what Councillor McCormack picked up, was my comment, is this getting worse? Because these figures in isolation don't actually show me anything really. So if you're able, for say a 3-year period, to give a view, I do accept the point you're making that obviously with COVID and the inability to correct rents, that's obviously impacted significantly.
Certainly happy to look at this as well and see whether or not we can put some trend information in there as well, because we do actually have it, and obviously report this to you on a quarterly basis. So happy to look at that, and clearly there's what we monitor, and then there's the write-off as well.
Okay. I think that covers that particular item, because it's only a summary, as I say, as opposed to where we have the reports to go in depth through them. So that takes us on to item 6, which is the Treasury Management Mid-Year Monitoring Report. Suzanne again.
Thank you, Chairman. Again, this is the half-year Treasury Management report, same style as you had in the previous quarter. Obviously, we recognise that it's likely that our investment income is likely to be down because of the continued low interest rates, which are still forecast to continue at that level. However, I think we have recently just decided to look again at some of our short-term cash and look how we can do that over a longer period to increase the return on that. But obviously that's a longer-term issue, so it'll take a little bit longer to feed through. But on page 23, on table 3, again, it's positive there to note that the valuation of our external funds the capital value continues to appreciate, as well as us getting some return of income there as well, which is a continued good position to be in. And so I will leave it there.
Any observations, comments? Councillor Punting.
Thank you. Yeah, the external fund valuation, it gives quite a bit of concern with regards to BlackRock, you see. And the others seems to be more okay, and the Egan Absolute Return Bond also is of some concern. Royal London Short Dated Credit Fund as well, although it's saying here our investment is £15,000. March 21, it's 0.74,776. So how come we are in bracket here, in more or less? Does that mean that it's minus?
Apologies. For the ones, yes, you're right. The valuation was as it was at the 31st of March, and then when it's been, again, the valuation taken at the half-year point in the 30th of September, it's lower than it was in March, but it's still more than what we originally put in for the Royal London and the Aegon one. Again, BlackRock has gone down a little as well, so they're all trending in the same direction. But again, these are long-term investments, so whilst we're giving you half-yearly snapshots, we do need to look at that. Some of those are starting to come towards their maturity date, and the Treasury Management Group that meets with with Sue as 151 officer is now looking at those to see what the next best option is. But again, you look at it as an overall basket rather than each individual thing. Each individual investment, we are still in a positive situation as far as our capital investment is concerned.
Which one are coming to maturity?
I believe it's the Royal London and the Aegon ones. So when I say coming to, that's in the next 12 to 18 months, not in the next 12 to 18 days. So, but we will look at the options, take the advice of Arlene Close, and Arlene Close will be talking to you at the January meeting about the current market position and the like. So you will have an opportunity to seek their view. They'll be obviously independent from officers.
Councillor McCormick.
Thank you, Chair. So, three things actually. First, looking at Table 2, there's various funds there. Am I right in thinking that the diversified credit funds and the return bond funds, they're actually hedge funds, for want another name? The supranational bonds, I mean, I presume these are things like IMF, World Bank or multilateral development banks. Have we got any information on those? And then looking at Table 3, do we have a date for the initial investment? The initial investment amounts there are very round figures. Two of the funds, Royal London Short Dated Credit and the Aegon Absolute Return Bond, are close to maturity, and they are marginally above the initial investment account, although the valuation changes for the year. The one that really does stand out on that is, even though it is recording a profit year on year, is CCLA, where we still haven't managed to make up to where we were with the initial investment amount, and I don't quite understand how far we are into that and when we expect that to mature, and how confident we can be that the CCLA fund is going to give us any kind of positive return on our investment. And you've also mentioned in your answer to Councillor Putty that really we should be looking at the things in the round. But the executive summary on page 19 says investment balances as at 30th September were 144.5 million. Average investment balances for the year are expected to be 133.7 million. So do we have an expected balance for the end of the year? Expected investment, is it going to be higher than 144.5, or is it going to be the 133.7, or is the 133.7 relating to all the year and it's been much lower and it's now coming to? I mean, I assume that might be the case, having looked at the graphs on page 24. It seems that things have taken a massive dip 18 months ago when the pandemic first hit with lockdown, and they're now showing signs of bouncing back in a strong recovery. But looking at the discrepancy between those two numbers, 10.8 million over a year would give cause for concern if we'd actually lost that sort of money in the space of less than a year.
I'll take that last one first because that's probably the easiest one to deal with. The investment balances represent whatever we've got invested at any one time, which includes our short-term cash. and that's what Table 1 is trying to demonstrate. So clearly we do have some liquid cash that we invest while we don't need to use it, and then we use it for paying various things, precepts and other payments. So what that's showing you, what that figure is aimed at telling you, is that as at the 30th of September there was 144.5 million invested in the market in different things, and then we are under the code required to say what the average investment balance over the year is. So that's an average of the money that we've had in the market at any one point at time. So at the moment, I can't say to you what I think it will be at the 31st of March. It broadly depends on how much cash we get in, how much cash we need to use. That's one of the issues. That's more about cash management. It's not that we've lost money. It's simply a statement of how much money we've got invested at any one point in the market. So that's the first one. In answer to your question about Table 2 and a breakdown, we do actually give you a greater breakdown on page 30 in Appendix 1, which sets out for you the name of each of the diversified credit funds, talks about the absolute bond funds, property, etc. So that's the full list there. The Table 2 summarises that. In terms of the names, and obviously links back to the value of 140.5 million that was invested at that point at the 30th of September. With regard to the CCLA, we always knew when we invested in it that there is initial lowering of the capital value that takes account of the costs, and we're already starting to see that come back. It is performing reasonably well. It continues to perform well. I can't give you an exact date as to when we'll actually see it, recover its full amount. All we can say is that it is absolutely trending in the right direction. And I think we've hopefully explained to committee before that was done on the basis of being a longer term investment rather than an immediate one, but still it remains our best investment at the current time.
Councillor Putty?
Thanks, Chairman. Well, with regards to the income yield, is that what we expecting, especially like when we are talking about the CCLA? We got 3.34%, and we do need to give the maturity date notices 3 months notice. So we got 10 million with CCLA. And the other one, MG Alpha Opportunities Fund, 2.37, and we have 74 days notice. And I'm looking at the length of time that the notice period is.
When we look at an investment, clearly each has a different notice period, and it's a bit like any savings account that one might choose as an individual. You're likely to get a better return of interest if you have to give more days notice, because clearly the fund managers then have to sort of get the funds out for you, and that's why you'll see the difference reflected on some of those income yields. And also it will depend at the time how the market was behaving at the time at which we took it on. So clearly what's reported on Appendix 1 is a statement of fact as what was happening at the time at which we started those investments, some of them quite a number of years ago now, 2014, and those were the terms of the investment at that particular time, and it's a balance of risk and cash availability that we always have to consider with any investment.
On Councillor McCormick's question was, are any of our investments classified as hedge funds?
I don't know the honest answer to that, but I'm happy to check with the team tomorrow to see whether any of them are deemed as hedge funds, and we will report that back.
Thank you.
Are these risky hedge funds?
Yeah, I don't believe any of these would be classed as hedge funds, but it's worth having that clarified properly. Because the diversified credit funds and absolute return funds, they're gilts, treasury bills, are all sound investments, but with very low returns. Councillor Tilbury.
Yeah, it's on our old friend, the CCLA fund. On the table, or sorry, on page 30, it refers to the income yield as 3.34%, but in table 2, it's for property funds, it shows 3.5, 3.43. Well, but it appears that is the only property fund we're invested in. But the other question is that 3.34? I'm assuming that's 3.34% of whatever the amount we've got in there is actually worth at that point in time, rather than, because of course if you just look at this casually, you see income yield on 10 million, that to be whatever, quite a lot. But of course, if it's obviously the actual value is 8.9, at one point it fell down to, and it's now picked up to about 9.5. It's about 9.5 million now. But I assume it's fixed to that rather than the other one, rather than to the initial. The initial one's particularly in that one is a particularly odd one, isn't it? We appreciate that, but
I'd have to ask the exact question of the team to explain it in any level of detail. But yes, obviously, when we talk about annualised returns, the market moves all the time. So clearly, we try and give you an annual position as well as what we thought the income estimate was, because obviously we take that on advice and that's what we work on. What I'm not sure, I might be correct in saying, but I will have this clarified for you. The income yield that's in the appendix might have been what the projected income yield was at the time we invested. And I appreciate it's tricky, isn't it? Because all the dates are different. But yes, you get your income based on how much is invested in there, and obviously you've got your capital appreciation as well. So I will get that clarified and a note circulated.
Okay, thank you. Councillor Poland.
Thank you, Chair. As you know, I've consistently, on every time I've been on audit accounts, raised issues on the management of this money. We are custodians of a significant capital sum. If you look at the efficient frontier chart, for those of you that know what that is, on chart 4, it does actually show that which we would expect, low risk, less volatility. I accept that, and I accept that the council's money must be in a relatively risk-free area. My principal concern has always and consistently will be that the returns that we are generating were not only were lower than inflation when I first raised this. The report in here by the advisors are now saying that inflation not going to be an issue. Well, I'm not quite sure which report they're looking at. The MPC are meeting on the 16th of December. There may or may not be a base rate change dependent upon the impact of the latest variant of coronavirus. My research has shown that actually some of these funds that we're investing in are really not doing that well relative to other people. And that is my principal concern. Yeah. And if we are paying an advisor, which I suspect is the case, to advise the council as to where it should or shouldn't be placing its money, I would question the validity of some of the advice that we're being given.
Yes, we do take advice on the market, but at the end of the day, the decisions relating to investment are delegated to the Section 151 officer. So ultimately, they make the decision, but that's based on the Treasury Management Strategy, and the comments about risk versus yield are being looked at as we look at the next version of the Treasury Management Strategy, which will come to you in January. And clearly, yes, we listen to their advice, and if we were to say to them, well, we're prepared to take the risk, how much more? And that's a conversation I think that will be held as part of the next debate on the next version of the strategy. So I do know that we've heard that message loud and clear, and we're looking at the strategy at the current time.
We'll have an opportunity on the 31st of January when the advisors come and present to us.
Sorry, can I just ask that when we get into that position where we're looking at somebody's advice, can we have a look at their management fees as well? Could you include that in the report?
Quite happy that we can advise you what we are paying for Arling Close, and I'll do that as a separate note. Yeah.
Okay. Yeah, I think we've done enough on that one, and I think the meeting in January is an opportunity to go into a bit more detail with them that's doing it. Okay, on to agenda item 7, which is the retender of the external audit arrangements. Just to make a point before Suzanne introduces it, a piece of background is on this committee, it was 4 years ago. I remember before we went on to this national scheme, our audit fee was £92,000, as I recall. So when we went on to the national scheme, we halved the cost, and it was a great surprise to me personally how Ernst & Young could do an audit for £42,000, bearing in mind their normal fees. So that's a sort of bit of background to this report. Suzanne.
Thank you, Chairman. The only thing I wanted to draw out from you, other than to say that this obviously has to be a recommendation onto Council as the decision-making body under the legislation, is that on page 39, Table 1, for the fees for 2019-20, we pointed out that that was still subject to some discussion with public sector audits appointment, and just as this report was going to print, we were advised that in fact that 99,765, our final fee is actually 62,680. So I guess the benefit of that collective procurement shows that in fact they challenged the auditors back collectively across the board, and the result for us was that whereas initially they'd sought to get 45,000 additional fees in round terms, we only paid an extra 6. The one-off COVID work was 7,000, and the additional work on plant and equipment and the VFM conclusion was said to be 6,700. So I will be adjusting that table, but overall I think that demonstrates the benefit of the collective approach.
Are there any comments, or are we happy to recommend as a committee that we carry on with the national audit system? Yep, I think we'll take that as... Oh, sorry, Councillor Tilbury.
Yeah, just a quick comment, Joe. When I first joined the council 20 years ago, we were paying about £120,000 for audit at that time. Just to put this in context, it just shows how much has been driven down over the years, or how much we've been overcharged back 20 years ago. I think it's more realistic, but yeah, I think, you know, the figures do have gone down dramatically. It's, you know, and that's not even allowing for inflation, is it? It's
Councillor Poland.
Chair, I think a point must be made that this is a significant achievement by the council in getting it down to the level they have, but also I think credit should go to the internal work that the council does, because I would imagine the external auditors, when they come along, although they have to do a lot of compliance work under the normal statutory obligations, I suspect if it's been done well internally, that must make a significant difference to them. Mm-hmm.
Thank you for that comment. I don't think internally we can take all the credit for driving the fee down, because clearly public sector audits do. The only thing we can take credit for is making our representations to PSAA that clearly we didn't feel that the additional fee was warranted. So we'll take that credit very gratefully. Thank you.
Okay, we're all happy with that. Yep. Okay, excellent. So on to item agenda number 8. The Internal Audit Progress Report, October to November. Richard.
Thank you, Chairman. Yes, this is the progress report for the work that the Internal Audit team have completed just in the 2 months of October and November, and also the current position with the outstanding audit recommendations. Concerning the audits completed, paragraph 4.1 on page 51, my report shows the reviews that we've completed in this time. So of the 4, there's 2 we've given full assurance, 1 substantial, and 1 we've given a reasonable assurance. Concerning recommendations, paragraph 4.2 on page 51 shows the latest position with outstanding recommendations. These are where actions we've agreed have yet to be completed. These are detailed in Appendix 1 to my report. And the summary reports of the audits that we've completed are shown as I usually do in Appendices 2 through to 5. My report. I'm just requesting that the report is noted, Chairman.
Noted. Yep. Okay. Thank you, Richard. So, item 9, protecting the public purse. So, Paul.
Thank you, Chair. This is a report to inform the committee of the work that's been carried out so far this financial year in protecting the public purse. I'm not going to add any further dialogue to that because I think the report stands for itself, and would just ask the committee to note the report if they would.
Any comments, observations, questions? I have one question, Paul. Is are we in this particular report? Are we in any way involved in what's bubbling along in terms of the fraud that's happening with the grants that have been handed out as part of the COVID schemes?
Yes, we are, Chair. We do. If you look at paragraph 7.3, there's just some information around this, and again, this is something we were doing last year as well, which was reported to committee in June. So what we're trying to do is give some assurance in the work that's done. A lot of work is done by the local tax team, but we are helping them with that, and we're doing our own data matching exercises to see if we can pick anything up. And we've had support from the Cabinet Office, part of the National Fraud Initiative exercise, which is done every 2 years. They've done special exercises through business rates. So if we do find any more issues, they'll be reported to committee on our next fraud report. That's due to come in June, I think it is.
Thank you. Are we happy to note the report? Councillor Poland, you have a... Sorry.
There was a question raised, I believe, not in the last Audit and Accounts Committee meeting, but the prior one. I think it was by Councillor McCormick, talking about the debts that we've got, or fraud, not really debt. And one of the things that struck out, which is actually in the report this evening, was council tax discounts. I assume those are people claiming them where they're clearly not entitled to. And it struck me, is there not a simple way that, given that we actually run the electoral register, that if people are claiming a council tax discount, that it could not be married up, or do you already do that?
Yes, thank you for the question. Yes, that is done every year. It's facilitated by the National Fraud Initiative. We provide both data sets and they send back the possible matches for us to investigate, and that's primarily the work as a result of the previous exercise. We're just in the process of compiling the data again for this year that will be sent to Cabinet Office later this month.
Okay, fine. Thank you, Paul. So on to item 10, which is the viewing of social networking sites, which seems to be almost negligible. So again, we're asked to note the content of that report, albeit hardly anything in it, which is good. Councillor McCormick?
Yeah, table on page 101 mentions quite a few reviews at the very beginning of 2021 when we were in lockdown. 22 out of 26 in January and March alone. I'm just wondering if there is any explanation for that. I mean, are we talking about Facebook posts that have been reported, or pages or accounts that are actively investigated? It does seem to be quite a bit of a jump between November, December 2020 and January, March 2021, and then nothing in the second quarter of 2021.
Sorry, yeah. Paul.
Thank you, Chair. The information of those would have been reported to I'd suggest the March committee, because this paper is presented each committee meeting, and I'd suggest it's primarily my team who carry out these viewing of social sites, and I can't give exact detail for the January and March ones, but I would suggest that they are related to any fraud-related investigations.
Okay, well, thank you. Okay, the report is noted. So, item 11, which is the work programme, which simply basically explains what we'll be doing at the next meeting. So January's quite an interesting one. Yeah. So we note the work programme. Which there are no confidential items, so I declare the meeting closed. Oh, sorry, Councillor McCormick.
Yeah, I'm wondering whether it's worth bringing an item to this committee. It would either be this committee or the scrutiny committee on the smarter ways of working, because at some point we'll have to review what's been happening with. I mean, it might be a bit premature now because they haven't all moved back into the building yet, but at some point we'll need to review it. There's been significant expenditure on it. What kind of return on investment are we looking at? And indeed, what the likely prospects are for rental income from the Parklands building now that we've got 2 floors vacating on the Parklands building. We're already effectively letting out the top floor to the police, and our CSPOs are in there. So I'm wondering if that's a suitable item for a future piece of work for this committee, or whether we should take it to the scrutiny committee.
Suzanne. Yeah.
My advice would be that would be a matter for the scrutiny committee. I don't think it falls within the terms of reference of this committee.
Yeah. I mean, as a member of the scrutiny committee, I would think that would be appropriate, especially as I think going back a couple of years, the smarter ways of working seemed to creep in. I don't know how much involvement there was in the policy committees to look at that and agree it, as opposed to it happened and we're seeing the results of it now. And it's probably a scrutiny issue rather than this one. Yeah.
Well, I mean, I think it was a windfall item because people were sent home in March 2020 to work from home, and that prompted a review about how we were going to be working in the future. So obviously we had 2 office buildings with people coming in Monday to Friday. We're going down to 1 office building. There will be hot desking and less less hours being spent per employee in the building. So I think it was an opportunistic thing, because even as recently as the tail end of 2019, I don't think anybody envisaged that we would have quite so many people working from home. But in terms of, I'm happy to accept it might be an item for the scrutiny committee. I cannot recall there being a council decision that originated from the cabinet or with any kind of political dimension to it. My recollection is that smarter ways of working was an opportunity. You know, it was a windfall based on the fact we had so many people at home, and we did not know at the time how many people would come back.
Suzanne, you have a view on that?
To my knowledge, and that obviously predates my time at the council, the programme was already in place. It was already taken through as a budgetary item prior to March 2020. So clearly the pandemic hadn't had an impact on every local authority in terms of people working from home, but it was always planned to happen and over this kind of timescale, in the sense of which years it was going to happen, and was part of the budget. But clearly that could all be explained and those things referred to in a report to scrutiny.
Okay.
Yes, Chairman, because the thing is that it is a new way of now life. People do need to really realize that we have come a long way now, and we have to really change. So scrutiny committee is a one to really look at it and then provide us.
Yeah. we consider all more mundane issues. Okay, I declare the meeting closed. Thank you all.